Hi and welcome to the first trade of the week of 2010. Using technical analysis is fraught with contradictions. One of these is that it's good to develop a strategy that works and keep to it, but on the other hand it's worth being aware of major technical factors that could ruin your trade. Last Monday I wrote about the 200-day moving average dilemma facing traders. Over Christmas, sterling had bullied its way back above the 200-day simple moving average, but had met resistance at the higher 200-day exponential moving average. I said then that even though the 200-day EMA had a better track record, I was going to wait for a confirmed break of either moving average before trading. This was a sensible, cautious approach, and I did trade successfully the following day when the break lower had been confirmed. But the following strategy could have made me money on day one. The debate over which 200-day moving average to watch was valid, but the technicals favoured resistance at the exponential moving average level of 162.30. Firstly, it had a proven track record of support and resistance throughout the autumn, and secondly, it double teamed with a 38.2% Fibonacci retracement of December's fall. So the smart move would have been to set a limit order to sell sterling dollar at 162.30. Right there. Sterling had started the new year well, and there was a risk that the move continued higher. Because of this, I'd have set a tight stop loss 25 pips above the line, far enough to protect me from stop loss hunters, but near enough to limit my losses if I was wrong. On a £5 bet, I would be risking £125. It's always good to start the year with a profit, so I'd have set a limit order to close £2 for plus 30 pips, bringing my stop loss down to break even. I still don't have a hard and fast exit strategy, so for now I'll carry on trading my stop loss at a 50p distance and using candle patterns and oscillators to determine when to get out. So, how would this trade have panned out? A limit order to sell £5 at 162.30 would have been triggered soon after 10 o'clock, and the move down over the next hour would have locked in £2 at 162. The following hour required a cast iron discipline to ignore the rise and keep the stop loss at break even. The reward was a sudden drop to 161.40. A tricky lunchtime session threatened the trading stop loss before a further fall took the price down to 160.85. The trouble with a pretend trade is that I can't say for certain when I've closed it out. In honesty, there were several rallies that would have tested my resolve, but if I'd made it through the day, I would probably have exited at the UK close rather than risk the overnight lottery. So that would have been down there. So for the sake of putting some numbers to the example, I bought back £2 at 162 and £3 at 161.05, the 4:30 closing offer. That would have given a profit of £435 for a risk of £125. The thing is, books and seminars are full of great examples of how easy it is to trade. And this example is as guilty as Bernie Madoff of deception. It's true the limit order would have worked, but my usual strategy of waiting for a confirmation would have put me at a lower price at around 162.20 after the red candle. And my normal strategy of trading 10 pips through the 21 period moving average with a MACD confirmation would have seen me stopped out for a loss around about I'd have gone in there and I've been stopped out as it crossed back over the 21 period line again. There were also enough mini rallies and moving average crossovers to have shaken me out before the final mid-afternoon session. So, potential wins, potential losses. Have a good weekend.